Good morning. We're excited to have you join us today. My name is Yoriana Aguilar, Business Assistant Specialist for Los Angeles County Economic Development Corporation. This webinar is sponsored by the LA County and Los Angeles County Economic Development Corporation. For the last 6 months, LAEDC's Community Connector team reached out to microenterprises, small businesses, and nonprofits located in LA County. We provided them with resources and guidance during this difficult time, such as where to apply for the federal and traditional business loans, grants, and reopen strategies. As we continue reaching out to business owners, they share with us that federal loans were not enough to sustain their business during this time or were not prepared to apply for any loans or grants. We decided to bring you a webinar that will help you to manage your finances and provide you with the strategies to gain capital for your business. I would like to introduce you to Miguel Acuña, who is an expert business development and finance manager with 18 years of progressive experience across a broad range of business development and financing functions. He is a former lending director and founder of Business Source Network for the City of Los Angeles. Miguel is the Chief Financial Officer of ATC Solutions. He counsels and assists business to access capital growth and job creation. Miguel is going to be our moderator for today's webinar, Strategies on How to Manage Your Finance and Capital in Time of COVID.
Hello, everyone. Welcome to the Managing Finances and Capital Strategies webinar, sponsored by the Los Angeles County Economic Development Corporation. Today, I will be your host. My name is Miguel Acuña, and I manage ATC Solutions, a consulting firm that counsels and advises small businesses and provides access to capital for growth and job creation. Today, we have a panel of 3 experts, and it is my pleasure to introduce to you Sebastian DeVivo. He is the co-founder of Bliss Ventures and Sophis Capital, both focus on inclusive access to capital for women and minority entrepreneurs. In this role, he has facilitated over $50 million in debt and venture capital investments to portfolio companies. Since the outbreak of the COVID-19 pandemic, Sebastian has worked with over 150 small businesses in California, obtained $5 million in disaster funding. Our next expert is Noe Castillo. He's a 10-year business and commercial lending expert, providing financing to small businesses in Los Angeles. Noe's skills and specialty is to provide excellent customer service, building relationships with clients, and identifying the loan programs that will best meet their needs. And our third expert is Sean Salas. He is the CEO and co-founder of Camino Financial, a data-driven financial technology company pioneering affordable credit and financial products to U.S. Latinx businesses. Sean has built a team of 50 plus associates across 2 offices in Los Angeles and Mexico City, supporting thousands of underbanked Latinx businesses across the U.S. And with that, I will let each of the panel experts introduce themselves to you.
Hi, and thank you, Miguel, for that kind introduction, and thank you to LAEDC for putting this together. My name is Sebastian DeVivo, and I'm happy to be here with you guys to share some tips on how to manage your business finances strategically and how to approach them so that you can weather some of the issues that have been coming up with the pandemic. Before we begin, I want to introduce 3 important concepts that we need to keep in mind, which are going to structure the way we approach our business finances. The first one, you have to think of your business finances as a ledger. What that means is that it's a record of money coming in and money coming out. Think of your business checking account. You deposit money when you make a sale. You withdraw money when you pay your expenses. That's a pretty straightforward ledger. However, a lot of business owners think that the checking account is the extent of their business finances, that's the ledger that they need to pay attention to, and that's what it is, and there's no strategy to it, and that's actually not the case at all. The second concept I want to introduce is that there is more than one ledger to your business finances. This can be anything from your balance sheet, which includes money that maybe you've made from clients that they haven't paid you yet. It includes money that you've borrowed that you still have to pay. Sometimes it includes loans that you make. A lot of small businesses make loans from the business to the owner. Those are all on your balance sheet. Those are all a ledger, and they're not reflected on your checking account on a day-to-day basis. They also require that you approach them differently, which brings us to our third point, which is that each different ledger needs a different approach. So you have to think about them strategically with different goals and different ideal outcomes in order to get what you need to get for your business to survive and hopefully thrive. And I know this is a lot that I'm throwing at you. I'll explain everything in a little more detail as we go along. So the first concept is the easiest one. So, you have one ledger, it's called cash on hand. It can be the same, it's basically your checking account. And it's just tracking the actual cash that comes in and the cash that comes out. So this ledger is very important in order for you to continue operating. It's important for you to pay your bills, pay your employees, pay yourself. So it's obviously something that you need to stay on top of, and you need to do it on a daily basis. So you always need to know every day, okay, what expense is going to come through my checking account? What am I going to need to pay? And what money is going to be there in order to cover it? This is, pretty basic stuff, so I don't want to spend too much time on it. I do want to point out that a lot of small business owners and entrepreneurs think that, okay, my bills are paid, I'm paid, things seem to be going okay. And they think, all right, that's the extent of my business finances. I'm doing well, and I'm good. And in fact, that's not the case at all. As I mentioned, what you have in your checking account is only a fraction of your business finances. And other than staying on top of it and making sure that you can cover everything you need to cover, it's just one small aspect of what you need to keep in mind. The second ledger, as I mentioned a little earlier, is the balance sheet. And this is very similar to your checking account, but it involves cash that is not actually in your account. So it's not cash that you have. So on a balance sheet, you're looking at how much money you owe. What do you owe your vendors? What do you owe somebody who's lent you money, a bank or an investor? And also what money is owed to you. As I mentioned, sometimes businesses lend money to the owners. This is an asset. This is a money that they have that's theirs, but that they don't have in their checking account. So it needs to be tracked separately. And that's why the balance sheet is very important, because it tracks and covers most of your non-cash expenses and helps you paint a broader and more accurate picture of your business finances and how your business is doing at any given moment. Most entrepreneurs only really think about their balance sheet when they have to make a payment. So, it's that time of the month, I have to make a payment, I owe this, whatever. You make the payment, you move on, and you're done, and you don't think about it again. Sometimes you think about it if you need to take out another loan, or you need to think about your interest spending. However, this can be a mistake, because you do need a specific strategy to deal with your balance sheet. And, because it's usually dealing with expenses that are liabilities, so loans, it involves interest rate. So the key point to remember and the key strategy to keep in mind when it comes to your balance sheet is that you need to stay on top of your interest rates, and you need to make sure that your cost of capital is as low as possible. So whether it's a loan that you've taken out from the bank, whether it's a line of credit that you use to pay your vendors, whether it's a vendor credit. So you sell radios and you need to buy 50 radios wholesale from a vendor, and you don't have to pay them immediately. You're getting terms and you're usually paying for those terms. So it's very important that you keep that in mind, because at the end of the day, 1% here or there might not seem like much, but when you add them up, they can become a significant burden to your business. And it's not a burden that you need to pay. If you just stay on top of it and make sure that you're strategic about your interest rates, then you can save your business money and prepare yourself, give yourself more of a cash buffer for anything that might come up. And then the third ledger, which is the most important one, is the financial performance ledger. So the way most business owners experience this is their tax returns. So it can be their financial statements, their profit and loss and balance sheet, which usually become the tax return, and that's what you report to the IRS. For most private businesses, this is the only official document that tells anybody, how your business is doing. So how much you've sold, if you've made money, if you've made a profit, how much you've spent in your cost of sales or your expenses, all of these are captured in your tax return. And for most private businesses, this is what you would show when you're asking for money. So a lot of people don't realize that the primary document that you provide to a bank when you're asking for a loan is your tax return. And the first thing the banker is going to do is look at your net profit. Most small businesses are used to not paying too much attention to the tax returns, except for, I don't want to pay taxes, or I want to pay as little taxes as possible. So they'll go to a CPA or a tax preparer. They'll say, here are my financials, figure something out so that I have to pay as little in taxes as I can, which is fine if you don't want to pay taxes. But what happens then? Say you report a loss or you report minimal net profit in your tax return. That's great as far as your tax liability is concerned, because you don't have to pay taxes. But then you go to a bank and you say, hey, bank, I need you to lend me $100,000. And the bank is going to say, oh, okay, well, let me check to see if you can pay this back. Show me your tax returns. And when you give them your tax returns, what they're going to see is a loss or a minimal net profit. And the first thing the bank is going to ask you, and rightly so, is, hey, I'm looking at your tax returns and it says that your net profit was $0. How are you going to pay back the loan that you're asking me for? And, you can't be like, oh yeah, oops, I just did that because I didn't want to pay taxes. Because again, for most private companies, this is the tax returns are the only official document that you use in order to communicate your finances and your performance. So you can't say, that was just because I didn't want to pay taxes, because they're going to say, look, I need to go by your tax returns, and your tax returns are telling me that you didn't make any money last year. So you don't, as far as I know, have any money to pay back a loan. So why are you asking me to give you my money when you can't pay it back? So it's critical that you keep that in mind, because without strategic tax returns, then there's no way for you to access capital. And what a lot of us need to realize is that it's possible to grow out of your net profit or the money that you make, but it's very difficult. When you really need to grow your business, expand your business, if you need to do a big marketing push, or you need to create a new manufacturing line, or you need to buy a new product to resell, All of these things require money, and most of the time your business won't have enough in cash on hand to cover it. So that's why having banks to lend you money at decent interest rates is important, because this allows you to go and expand your business, and to do it at pretty minimal cost. At the end of the day, if you're going to a reputable bank or a credit union, you're looking at 6, 8, 10% interest rate. And if you borrow 100,000, and that's going to help you generate an extra 300,000 in revenue for your business, then the 10,000 that you paid in taxes is not a big deal, because you paid 10,000 to make 290,000. So it's a pretty great trade-off. And it allows you to grow at a rate that you wouldn't otherwise, because putting together 100,000 in cash out of your own net profit takes time and can be very difficult. And at the end of the day, you don't want to deplete all your cash in order to grow, because if anything happens, then you don't have any cash, and God forbid another disaster happens like the pandemic, and then there's no cash that you can use to stabilize and get through it. So that's why using the bank's money is important and almost always beneficial for a small business. Now, again, your tax returns are how you show your business's financial performance, which means that you need to be strategic. And the way you are strategic is by showing how much you report in your net profit. So if you want the bank to give you a loan, you have to show them tax returns that show that you have enough in net profit to cover that loan and then some. You don't want to say that, hey, give me a loan and the loan payment is $1,000 and your net profit for last year was 12,000, because if all you can cover with your available cash is your loan payment, then anything happens, you're going to be in trouble. So you always want to have a little buffer there to show the bank that, yes, I can make the payment, and I have a little extra to cover any unforeseen circumstances that might come up. So if your monthly payment is $1,000, showing a net profit of $1,250, $1,300, $1,500 is always the safest way to go. So I mentioned bank loans. They're obviously very important, and they're critical for you to grow your business. In order to get a bank loan, as I mentioned, you need to show tax returns that show that you have the ability to make your monthly payments. And this is, at the end of the day, the most important factor that a loan officer is going to look at. Credit is important. Your business credit is somewhat important. Collateral can be important, and Noé is going to talk a little bit more about this later on. But at the end of the day, first and foremost, you need to show that you can make your monthly payment. And the way to do that is your net profit and your tax returns. There are other ways to get money. You can go for venture capital, which is selling a part of your business in exchange for an investment. This is a entirely different ballgame, and usually requires that you show that you're a very high growth company. Or in these difficult days, you can go for grants and disaster funding. And what you show for these is that you have been affected by the pandemic, and that you have acceptable uses to which you're going to put the money. So really quickly, I'm going to go through the most important thing to keep in mind when it comes to your financial performance strategy. So your third ledger, you need to plan at least a year ahead. So if I know that next year I'm going to need a loan with $1,000 monthly payment, then for 2020, this year, I have to show that I have $1,300 in available cash flow every month, so that when I submit my tax returns and go ask the bank for money, they're going to see that, oh, in 2020, you could have made the payment. So you show that you have available cash flow, so you qualify for the loan. Banks usually want to see 2 years that you've been able to pay it for 2 years, but SBA loans allow you to show basically 1 year, and most banks will work with you. So again, plan a year and ahead. Make sure that you're showing enough net profit to cover your monthly payments. This means that you're going to have to pay taxes. It's a simple calculation. How much are the taxes going to cost you? And set that aside. Set that next to how much you're going to make. So if I have to report $20,000 in net profit so that I can get a loan for $100,000 so that I can generate $300,000 in revenue, then it's not a big deal to pay the $5,000 in taxes or the $2,000 in interest rate, because that $5,000 in taxes and $2,000 in interest is generating $300,000 in revenue. So it's always a simple calculation. And the last thing to keep in mind is that whenever you borrow money, it always has to be to generate revenue. It always has to be to grow. You never borrow money to cover expenses that aren't going to generate revenue, because you're just going to create more expenses for you and you're just kicking the problem down the road. So always make sure that you're setting up an extra manufacturing line, buying a new product, new marketing campaign. Anything that you're doing with borrowed money is generating more revenue. So just to summarize, I mentioned that your business finances you can think about them as ledgers. It's not just one, it's not just your checking account. But your checking account is the one that you interact with and engage with on a daily basis. So the strategy for this is just, hey, make sure that you have enough to cover your expenses for that day, that week, or that month. The second ledger that I discussed is your balance sheet. And here, because usually we're talking about loans, either coming in or going out, then you just have to think about how much it costs to have that loan. So how much is the interest rate? And what you want to make sure is that you're paying the lowest cost of capital that you can. And finally, the third and most important one is the ledger where you show your financial performance, which is your tax returns. And the strategy for this one is that you need to always plan a year ahead, so that the money that you need next year, you can show that you afforded this year through your net profit. So always plan ahead, make the calculation, determine how much you're going to need, determine what the payment is going to be, and then adjust your net profit so that it shows at least that. And with that, I'll turn it over for questions. Again, thank you, Miguel. Thank you, LAEDC, for putting this together. Happy to be here and happy to answer any questions. Thank you very much.
Hi, good morning. Happy Wednesday. Thank you for the introduction, Miguel. My name is Noe Castillo. I'm a loan officer with CDC Small Business Finance. CDC Small Business Finance is a nonprofit mission-based lender headquarters in San Diego, but we also have footprint in the whole state of California, Nevada, and Arizona. Part of my job is to help the clients understand the loan process, and I'm here hoping to do the same with you. So I'm going to be talking about a couple of different things, so let's jump into the agenda for the time being. So in regards to some of these topics I'm going to be talking about today is going to be in regards to some of the loan guidelines, the 5 C's of credit, the debt service ratio, or also known as DSCR, and understanding your business lending capacity. So the first topic will be the lending guidelines. So now keep in mind the guidelines are used kind of a set of rules that institutions they're going to have to use in order for them to consider your loan package. So now keep in mind that each institution will have their own guidelines depending on the loan program. So let's talk about ours with CDC. So for instance, with CDC, we do have a credit score requirement, which in this case is going to be a 680 FICO. We're also going to have something that is going to call the debt service ratio, which I'm going to be talking after the presentation. In this case, it's going to be one-to-one, and then we'll also review based on projections depending on the project. In some cases, some institutions will have different guidance based on if the person has a bankruptcy, foreclosures, or short sales. So in our case, we asked for them to be over 10 years old or to be off the credit report. The third one is, the next one, I'm sorry, is going to be the injection requirement. So depending on the projects, in some cases, there might be an injection requirement, also known as down payment. So in our case, as a company, we do require a 10% for any business acquisition or the purchase of an existing business. We're also going to require a 20% for any startup projects. And in most cases, a 0% personal injection or down payment for any equipment or inventory financing. In regards to collateral, in most cases, collateral might not be asked. In some cases, it might. So depending, once again, depending on your project, some banks might ask you to pledge a collateral, which it could be sometimes either property, cash collateral, life insurance. In some cases, it might be different. In our case, our loans amounts, they go anywhere from 20 up to 250,000. Once again, your institutions, some of them are going to be slightly higher. In some cases, some institutions do not lend anything below 50,000, some of them below 100,000, or in some cases, even some below 250,000, depending on the loan program. In our case, we do provide startup financing. So for any startup financing, we require that the borrowers have a 2-year minimum experience in this industry that they're trying to start the project on. So now, once again, this is a program just to give you some idea, some of the rules or standards that some of these institutions we use to make this loan happen for you. Now, let's talk about how the business determines your loan package. Okay. Now, there's something that is known as the 5 C's of credit. Okay, which is going to be credit, capacity, collateral, capital, and conditions. Okay. Now, in this case, they're going to consider all your strengths and weaknesses depending on your loan situation, and therefore they're going to determine if your loan has enough strength based on these 5 C's of credit. So let's jump on the first one. The first one is going to be credit. So this is where the financial institutions are going to look at anyone that owns 20% ownership or more into the business. So for those that own that 20% or more, most of the time they're going to ask or they're going to inquire for them to get a copy of your credit report, which is going to provide us, of course, the FICO score. Is going to require any payment history, your percentage of revolving debt available, your length of credit history, and what type of credits you have. Is it mostly revolving, or do you have a conjunction of both revolving and installment, which is going to be very important. So understanding your credit score and understanding how you're doing on every credit bureau is going to be very important. So in some cases, you are more than welcome to reach to some of those websites that I provided, which is annualcreditreport.com or credit.org, to have an idea on how your credit is doing. The second C is going to be capacity. Basically, the capacity, what that basically means is does the business and the person make enough money or have enough repayment capacity to pay the loan back. Okay, so in this case, in the businesses, they're going to look at the business tax returns, the interim financials. In some cases, the projected income, if you are, perhaps providing projections, if you're talking about an expansion or even as a startup, we do some projections. In regards to the personal income, they're going to take in consideration if you are going to provide a source for income from another resource, if the spouse is bringing some income into the equation, any military income, rental income, retirement income, any other source of income that you can bring into the equation. So basically, they're going to take both of the incomes, and that's what brings into your cash flow. The third one is going to be collateral. Like I mentioned to you before, based on the guidelines, in some cases, some lenders might require like collateral. It could be many forms of collateral that could be used, but pretty much it's going to be a tangible, that can be sold in case the lender is not able to recollect the payment. In some forms of collateral, like I mentioned to you, it could be your personal residence, business assets, also known as the UCC filing. And some other times personal assets, like your personal vehicle, depending on the value, or life insurance, or even maybe if you have like a retirement account, maybe they might put a pledge on that. I mean, it might be different based on the institution. The next one is going to be collateral, capital. I'm sorry. So the capital is basically it's your skin on the game, your down payment, like how much are you coming into your project in some cases. So based on depending on those resources, it could be either coming from your savings, from a home equity line of credit. Maybe your partner's contribution is coming into the project, and sometimes it could be gifted from friends and family. So like I mentioned before, for startup financing, most of the time is 20%, and for business acquisition, it's going to be 10%. Now, most of this money has to be liquidity that is not being lent from credit card advances. So make sure that you're very aware of that. Okay. The next one is going to be conditions. So conditions basically means is what's the current state of the market, or what are the current conditions of the market, or in some cases, how is your industry going to do right now if there was a recession? How would your company or your industry will make based on that recession? So it's just pretty much understanding the external environment outside your company that could potentially affect the loan outcome. So just to give a little quick recap of the 5 C's of credit. So once again, like I mentioned to you, the capital is basically the money that you're investing into your business, often known as down payment. The next one, collateral, is basically if you're going to pledge an asset to back up your loan. The third one is going to be conditions, just basically understanding the market analysis of the trends of your industry. The fourth one is going to be your character, basically, once again, how's your credit is doing, you don't have any defaults, you have a good credit history, and good payment history. And once again, like I mentioned, capacity is basically your financial ability to pay back to the lender. That's what that really means. So now jumping into the next topic, we're going to talk about the debt service coverage ratio. So basic definition of that is basically it's a measurement of available cash to pay the recurrent debt obligations. So it's in some of the, and a lot of the times it basically is understanding if a company or a bank financial institution is going to lend you money, how much does your company needs to make comparable in order for that company to lend you that money. So in some cases, based on this example, in some cases, conventional lenders, they might require you to make anywhere from $1.25 to $1.50 in order for them to lend you $1, which is the ratio 1 to 1.25 to 1.5. In some cases, if it's an SBA lender or if it's an SBA loan, that there's going to be a small decrease on that. It could be in order for them to lend you or lend your company $1, they're going to require you to either make $1 to $1.15 on that. Now, in our case as a CDC, we do our DCR is 1-to-1. So basically, we're going to require your company to make $1 in order for us to in order for just to consider you to lend you $1. So with that being said, let's jump into some examples, what I mean by that. So let's look at example 1. So in this case, let's say for the purpose of this example, your company make $907,540 in gross income. Now, after, if there were no cost to produce anything, your gross profit is going to be the same, $907,540, which is 100%. But now in this example, let's say you try to, or maybe based on your CPA recommendations, you try to limit your liability, then your total expenses come out to $912,116, which gives you a negative net profit of $45.76. Now, in this specific example, let's say that maybe you have a small add-backs, okay? Now, a small add-back sometimes, in most of the cases, is going to be interest expense, depreciation, amortization. Those are the most typicals you're going to see. So in this case, let's say you had some small add-back for 1,046. At the end of your equation, if you look at the yellow square, you're going to notice that the available cash flow, it's going to be a negative 3530. So with this specific example, where you're telling the IRS is that your business had a negative income of 4,576, which gives you a zero liability, but you indicate that, once again, because of that liability, the negative income, you don't have to pay any taxes back. At the same time, what are you telling your financial institutions is that the available cash flow, it was negative 3,530, which you have zero repayment ability. and therefore, because of the loss, you cannot pay the loan back. There is no additional income to being able to pay it on a loan. So now let's jump to the next example, which is example number 2. For this example, let's say your company makes 914,532. Now the cost to produce your product is 698. So that leaves you at a gross profit of 834,000. Now the total expense of that after your deductions, they leave you at a net profit of 17,539. However, you have some considerable add-backs into the project that could bring your net income after your add-backs into a available cash flow of 61,422,000. So now what you're telling the IRS, once again, going back to this specific example, it means that the only taxable income is going to be your net profit, which is going to give you zero liability because, once again, you took a loss. You don't have to pay much on taxes or none on taxes. But what you're telling the financial institution is that the available cash flow is going to be 61,422,000 after your add-backs, and your repayment ability to make a loan is going to be roughly about 41,000, and that's based on a debt service ratio of 1 to 1.20, 1 to 1.5. Assuming that this is going to be a conventional loan. So now let's jump into the last example. So let's look at now a completely different scenario where your company makes a income of 1.7 million. The cost to produce is about 983,464. Your gross profit is going to be 749,634, and you have a total expense of 617,081. And a net profit of 132,553. Now, after we look at the add-backs, once again, looking maybe there is some interest, expense, depreciation, amortization. On this one, we had an add-back of 236,000. I'm sorry, 263,211. So that gives you a, with a total available cash flow of 395,74. So what you're telling the IRS, like I mentioned before, you ended up having a total income of 532,553. Total liability is going to be 18,309 because that's going to be the tax bracket that you're going to pay based on the net profit. But what you're telling your financial institution is that you have available cash flow of 395,764, but you are going to have a repayment ability of 344,000 based on a 1.215 DCR. So once again, this is assuming that's probably an SBA loan. So understanding these numbers are going to be very important. So that's really about me as far as this number. So once again, thank you for your time. All my contact information is there if you have any questions or concerns, my telephone number and my email address. And thank you for your time. Looking forward to the Q&A.
Hi, my name is Sean Salas. I'm the CEO and co-founder of Camino Financial. And it's a pleasure to be here today. And I want to thank, first of all, the LAEDC and everyone involved with organizing this event. It truly is a pleasure to be here, to be able to speak about a very important topic, which is how to navigate your cash during COVID and how to access capital if required, because of course, that's a function of your cash management. A little bit about myself before getting started. I am the proud son of an entrepreneur that opened a restaurant chain here in the greater Los Angeles area. She's an immigrant, and so she came to the United States with the great American dream and saw entrepreneurship as her only means of generating wealth for herself, her family, and her community. And over the course of 25 years, my mother opened over 30 restaurants. And so it truly is a pleasure to have seen that experience. Also, a bit devastating to see my mom lose her business abruptly. At that point in time, my twin brother and I were 12 years old. We thought the American dream was gone, and we moved back to Mexico. Actually ended up being a blessing in disguise. I loved growing up in Mazatlan, Sinaloa. I truly consider myself a Mexican American in every way you can interpret that label, if you will, that I proudly place on my shoulders. And but at 20 years old, I came back to the United States, relived that immigrant story that many of us experience either directly or through our parents. Went to college at Berkeley, cut my teeth in finance and investment banking and private equity. And thereafter, I realized that I was making rich people a lot richer, but I wasn't necessarily fulfilling my own destiny. And I really wanted to work on investing in our community, investing in Latino-owned businesses in particular. I saw that there was a large and unmet opportunity in extending credit into this market. And I was lucky enough to, what my mom's experience, what planted a seed, but I was able to finally germinate that seed while I was lucky enough to be accepted into Harvard Business School alongside my twin brother, Kenny Salas, who's my co-founder at Camino Financial. And so while at Harvard Business School, we were able to germinate Camino Financial into a little plantita that ended up being called Camino Financial. And today we're an online platform, pioneering affordable credit to underbanked Latino-owned small businesses here in the United States. We're a digital-first platform, so you can find us at www.caminofinancial.com, and we're happy to be serving our community on a national level. Now, as it relates to the topic today, it's a very important topic, and in order to cover it, I want to share some data with you. So at Camino Financial, we're lucky enough to currently manage the largest Latino-focused fund in the United States. It's a $100 million fund. And through that fund, we're able to attract quite a bit of applicants, as you can imagine, per month. We attract, at pre-COVID levels, about 3,000 applicants per month. And we were able to get the application data. And this is application data where we actually have the credit information. These aren't just people that are giving us their basic contact information. No, these are people that we can dig deep into their credit profiles and understand a little bit more about their credit worthiness, where are they located, and so forth. And we're able to aggregate that data, of course, in an anonymized form, and release that in the form of research every quarter. We call it the Camino Financial U.S. Latino Small Business Survey. So please check out our survey. It's available online through our website. And we just released a report at the beginning of this month, so this is fresh off the press, about the impact of COVID on Latino-owned businesses here in the United States. And once again, this is derived from a very large pool of application data, but then we also did a breakout survey to a smaller pool of 350 or so Latino small businesses, specifically on the impact of COVID, because we thought that was going to help us make an informed view on how people are doing. And so while it's a smaller sample size than the 34,000 applications that we've accumulated over the last 18 months, this sample size is a bit more focused on the impact of COVID. And so we were able to derive some very interesting findings from that pool of data. First of all, it's worth noting that this is a follow-up survey from our Q2 report. In Q2, we actually did an initial report on the impact of COVID. And just a quick recap of that, it was showing that 80%, roughly 79% of businesses at any point in time had to close their businesses down. And of course, that's a big number. That's very scary, because of COVID. But what we also saw is that when we conducted that survey at the beginning of June, right before the first resurgence of COVID, hopefully the only, but that's still in the air. Unfortunately, there's likely a second resurgence, or many would claim it's already happening. But before the first resurgence, starting in the second week of June, we were able to note that that it was 67% of those businesses, 67% of businesses had already reopened their stores, which is great, right? If 80% at any point, 79% at any point in time close their stores, when you take a snapshot at the beginning of June, 67% stated that they were already open for business, and the remaining 33% were stating that they were optimistic about reopening their business. And so we went back and looked at the data and saw that, hey, let's see how people are doing now. And what we saw is that the market is still resilient in that people are getting by, and which is great news. We also noted that when we look at the access to PPP funding, our last survey actually showed that the PP penetration into the market was incredibly low. In fact, we were seeing that only roughly roughly 70% of people were not applying for PPP. Can you believe that? Not applying for PPP. And only 30% were, of course. And of the 70 that weren't applying for PPP, give or take, people were just, one, discouraged to apply, didn't think they would qualify or needed some technical assistance. And so this time we kind of broke the survey out in two sections. We said, okay, what about those that have a pre-existing relationship with the lender, in this case, Camino Financial, and those that got approved for a loan with Camino Financial using our application data, but didn't take the loan for X or Y reason? Well, what we found, but we think that that's not just a proxy for Camino. We actually think that if you have a pre-existing relationship with the lender, this dynamic should, to an extent, play itself through. Although I do think there is secret sauce in the Camino Financial relationship. More on that later. And so what we found is that the overall penetration of businesses accessing PPP was roughly 16.5% of those that had a relationship with Camino, versus those that didn't have a relationship and didn't take the loan was 2.5% penetration. I'm sorry to say that the national averages are actually around 2.5% for all Latinos. And then the national average for any small business accessing PPP funding is around 17 to 18%. So we were actually right around the national average if you were a borrower for Camino, which is great news, and which is 6.6 times higher than those Latino-owned businesses that didn't have a pre-existing relationship. So there is truth to the headlines that many Black and brown businesses, in particular, in this case, Latino-owned businesses, weren't able to access PPP funding, roughly 2.5%. And there's also another research report by LBAN through Stanford, the Latino Entrepreneurship Initiative and Latino Business Action Network. And I think it's titled The Ongoing Impact of COVID-19 on Latino-owned Businesses. And they also did a research comparing the Latino cohort versus the white cohort. And what we found, what they found is that the PPP coverage rate was around 3%. So we're not off by a lot. We said 2.5%, they said 3%. So very close numbers, just as a cross-check and verification of where the direction of these numbers are going. So this is a big deal, but I would say that the caveat of this would be that if you have a pre-existing relationship with a community lender in particular, maybe if you have a pre-existing relationship with a big bank, right? I know there's been some concerns around different big banks not necessarily serving their clients. Although, to be fair to big banks, they moved most of the PPP funding. To be fair to community banks, they were probably the most efficient at moving PPP funding. So it's just worth noting the facts. But I think, once again, we're Black and brown businesses, in this case, Latino businesses, getting the short end of the stick. The data does tell us that that is the case. I'll leave you with another really interesting slide when we compare the non-borrowers versus the borrowers, is that the cash on hand had a real impact. If you were a non-borrower, you were more likely to have less cash on hand versus borrowers. In fact, if you look at the bar data, you see the inverse relationship as it relates to cash on hand of borrowers and non-borrowers. So that's a really big deal. So, the more likely you have a relationship with a lender, the better capitalized you're likely to be, which makes sense, right? But a lot of people don't think of a lending relationship as differently, right? Whereas no, you have to think about it as it's capitalizing your business. It's not just an interest rate. It's worth noting that clearly Latino businesses, compared to what the numbers I was showing you before, now 78% of businesses have reopened. This is pre the second resurgence. So we may have to do a follow-up on on the impact after the second resurgence. And once again, that's compared to 67% in last quarter. So that's good. And 70% believe that their businesses will be better off. So of course, Latinos are optimistic, and that's not surprising. That said, I think it's worth noting that we're still not out of the gate. Despite the resiliency, most of our sales have not even gotten close to recovering. 46% of their sales have declined more than 30%, and only 14% of Latino businesses are even doing better. So the reality is, right, that the great majority, 86% of businesses are flat to doing worse than they were before COVID. So the jury, is still out. I mean, the verdict is still out in terms of how well we weathered the storm. Clearly, capital is a key part of making sure that we can do it properly. And so these are all very important elements of how to think about managing through COVID. I can tell you first-handedly that it is not an easy environment to navigate through. I'll leave you with, what can Camino Financial do for you? Well, as you can see, by having a relationship with Camino Financial, independent of whether PPP comes out again, you're more likely to get access to relief funds. Even though we weren't a PPP lender ourselves, we were the first to say, hey, our product is not the best for you right now. You need relief funds. You need free money. We're not in the business of giving free money. So take the free money, and you're 6.6 times more likely to get that free money if you had a pre-existing relationship with Camino. You're more likely to be better capitalized during these times. We have different products for different profiles. I will say where we differentiate ourselves is that we're a non-bank product. So while we won't be the cheapest, as cheap as a bank, for instance, we won't be as expensive as many other online lenders and merchant cash advance. I'd qualify us in the middle. So you'll have annual interest rates in the 20s. But for people that are looking for a 2-year term monthly payment, no prepayment penalty, and there's growth in the horizon, it's an unsecured loan, which doesn't require collateral. We do require a personal guarantee, so it's worth noting that, but we don't require collateral as a requirement. So because of that, that just gives a lot of businesses the flexibility to move money, and we can give you a pre-qualification in seconds. If you go to www.caminofinancial.com, get pre-qualified, see your pricing. It doesn't impact your credit score because we do a soft pull of your credit to get you quick pricing. And if it makes sense and there's an investment to grow, that's great. And we call ourselves Camino because we also acknowledge that taking a loan with an annual interest rates in the 20s is not necessarily and there's a range, of course. It is not necessarily the optimal place to end, but sometimes it's the best place to start because there's a lot of alternative lenders out there that are charging well above that. And we do offer the speed, the flexibility, and the simplicity of online lending at what we consider affordable starting points with a path to more money at lower interest rates and longer terms. Thank you very much, and I look forward to the Q&A. Miguel, I think this is the chance for you to ask us questions.
Well, thank you guys for these great presentations, very informative. Thank you for taking the time to do this. We saw a few questions down below and they were answered by some of you from some of the participants. But one important thing, and I think Sebastian sort of alluded a little bit to it, and I think you all kind of hit on it when you're talking about cash flow, you're talking about credit. When you're prepared to do this, and I think there were some recommendations, but I want to make sure that it is very clear, because I think most of U.S. lenders look at the tax return as one of the primary documents to determine whether people have the ability to pay a loan back. So just kind of dive a little bit deeper into that issue, how important it is for people to have a tax return that is well done, that is well put together, to be able to then access that capital that they're seeking. And I'm gonna go start with Sebastian, for that answer.
Yeah, I mean, the tax return is a strategic document, and it's strategic for your tax liability, and it's strategic for access to capital. So if you're going to go to a bank, I mean, banks, lenders, they look at many different criteria, but ultimately they're just going to look at your cash flow and say, can you pay this back? So the document that's going to show them that is the tax return. So if you don't have a strategy for your tax return, if you're not strategic about your tax return based on what you and your business need, then you're not going to get access to capital. And that's a shame, because especially in these hard times, you can get pretty low cost capital out there. It's one of the, cheapest ways to grow. And as long as you play the game, you know what you need to say, you know what the banker is reading when they look at your tax returns, then you have a shot at it.
Excellent. And I'll ask also Sean to chime in on this.
Yeah, I'm glad. Thank you, Miguel. So I think where alternative lending products may be differentiated from a traditional bank product, or even from a traditional lender, not all traditional lenders are banks, as our friends at CDC are, right? Is that at Camino Financial, we have two products, a microloan and a small business loan. The microloan implies, of course, it's a smaller loan. It's a bit more flexible in terms of our underwriting. And one of the areas of our flexibility is that we don't look at tax returns. But I don't want that to come off as a contradiction to what Sebastian just said right now. On the contrary, we're the first to tell you tax returns are incredibly important, that you need to report your taxes on time, do a full, proper report, work with a bookkeeper, not with the tax preparer at the end of the year, with the bookkeeper on a monthly basis, so that your books are in order, right? It's not only the legal and ethical thing to do, it's the smart thing to do, because if you ever want to access the lowest cost of credit products in the market, it's the only way. And so I'm very open and clear with people. Our annual interest rates are in the 20s, in the low 30s, and so taking capital without tax returns comes at a cost to you. Now, there's still a lot of demand for our product because you may have an investment opportunity within your business that will deliver a very strong return on your investment, even if the interest rates are at the rates that I just discussed. And that's great. I always tell people there's only one reason to borrow money, is to make more money. But that said, while we do cater to more informally operated micro businesses, I don't even call them small businesses anymore. They're micro businesses. We call ourselves Camino at the same time because while we acknowledge sometimes this is the pragmatic starting point for a lot of micro businesses that may not have all their paperwork in order but need money today, we don't think it should be the end point. And so we need to create the path or the camino, if you will. And part of that camino is getting your tax returns and your paperwork in order so that you can qualify for longer term, more money and cheaper capital.
Excellent. And so, and to just kind of go a little bit, just a little bit further on this, and I'll pose this to Noé. Do any of you offer, technical assistance, or do you guys make recommendations to some of these business owners in order to help them improve their position in order to access capital for the business?
Yeah, thank you, Miguel. So pretty much in this case, in our case, we do offer, pre-loan advising, and also in some cases, depending on the program, we might also offer advising after the fact. So, I mean, a lot of the times when I review the loan packages and I feel that they're not ready, we also work with a network of different other nonprofit organizations that can help the client and guide them, for whatever that they might be missing. Maybe the financials are not correct. Maybe they need to make corrections to it. Maybe they might need to work on projections in order to make the loan happen. So, I mean, kind of going back to what Sebastian mentioned, it's very important that, and both Sean and Sebastian mentioned, is going to be very important that you guys work with a CPA, because the CPA is going to kind of walk you through that process and make sure that you're going on the right track. I mean, a lot of times people, try to save, dollars, but in the long term, you're actually probably losing thousands by not, plugging the right numbers in your report. So it is going to be very important that you look at the right numbers in order for people to grow.
Excellent, thank you. And getting back a little bit into that profit and loss statement that was mentioned during some of the presentations on how important that is there any way that these business owners can learn to manage these costs and lower some of these costs of doing business so that they can improve their net profit at the end of the year? Are there any tricks, any magic tricks, or is it just, things that they can learn to do for the business? And I'm going to start with Sean.
What I would say here is, so we, as an alternative lender, a digital first lender, we do use alternative data sets that go beyond the P&L, for instance, to look at the financials of a business. And I think, and the reason why we do that, it doesn't mean that we're not looking at, fundamentally, we want to assess the financial stability of the business, which is what balance sheet gives you, which is what a P&L gives you, which is what your tax returns help you indicate. But the way we go about it is a bit differently, Miguel, in that we will do a direct entry into your bank transaction data. And some other alternative lenders actually do a direct input into if you're on QuickBooks, they'll do a direct integration into your QuickBooks accounts. We don't do that, but other alternative lenders do. So I just want to be mindful of the spectrum of alternative lenders in this space. And what they're able to do is look at that bank transaction data and dissect from that. And then from that bank transaction data, we create our own custom P&L, Miguel. So it's not that we don't look at P&Ls, is that we're able to disaggregate the last 6 months of bank transaction data. If you have multiple accounts, we can aggregate the accounts too, and then we'll create our own P&L. And then based on that, we're able to underwrite and fund the loan efficiently. And the reason why we're set up that way is because not everyone, does the reporting and the accounting of their books the same way. Even though there should be standardization around what a P&L is, we just find that it's easier for us to standardize it within our own format and plugging into the raw data to do that. And we don't just look at transaction data, and we don't just look at credit data. We also look at what others call big data or alternative data sets. And that can be data sets around your website behavior. That can be data sets around the geography that you're operating in, and so forth. And what ends up happening, and this is why you have to be very purposeful and intentional about lending and designing around underbanked communities, is even some of these like artificially driven lending platforms discriminate against Black and brown communities in particular based on what big data sets they're using. And so it's important that you not only take those data sets, but you make sure that you're being intentional around using the data sets that increase inclusiveness versus discriminate. Because while there are laws against, like, for instance, lending on the basis of age, right? Regulation hasn't caught up to these alternative data sets. And so you have to be very mindful, even as you navigate through the alternative lending environment, being mindful about who you're working with within that environment. And that's why in the scheme of alternative lending, our pricing is usually 10 percentage points below a PayPal and an OnDeck. And I'm being generous with them. It's usually about at least 10. It's probably 10 to like 50%, because some of these people charge interest rates well above 50%. As people know, number one. And number two, our monthly payments, because we extend longer terms, is 40% lower as well. So being intentional as well about what alternative data sets you're using and how you use it to increase inclusivity is equally important. And it's nuanced based on the lender you're working with for in the environment.
Thank you. And I know Sebastian sort of works around the cash flow improvement issues. So what about you? What can you offer or say?
Right. So first, financial reporting is extremely important. And if there's one thing that we've learned from the pandemic, it's that staying on top of your cash is absolutely necessary, because you just don't know what tomorrow is going to bring. So for a lot of us, paying a bookkeeper, keeping our finances in order was just a once a year visit to the tax preparer, and that's it. A lot of people didn't qualify for PPP or qualified for much smaller EIDL loans because of that. So it might seem like you're saving money every month, but you could be leaving thousands of dollars on the table, and that's just not worth it. So give it the importance that it deserves. When it comes to playing with cash flow, so as Noé mentioned several times, the trick is always, what does the IRS consider an expense that the bank doesn't? So that's why depreciation and amortization are great, because according to the IRS, it's a cash expense like any other. So if you depreciate a truck or a machine for $20,000 of its value, your income statement shows a $20,000 expense. And that's great, because it's a $20,000 expense that the tax return shows, but it's not $20,000 in cash that left your account so that you could pay for something. So that's the most flexible and the best tool to use when it comes to playing with your cash flow. That's the biggest cash flow hack. And that's depreciation, amortization, both of which are related to assets. And most CPAs don't really pay too much attention to it, because their focus is just, okay, they don't want to pay taxes, so we'll just do what we need to do. Sit down with them, say, look, this is the capital that I'm going to need. These are the assets that I have. How much can we depreciate? How much can we amortize? I need you to go to bat for me and put these in my tax return, so that A, I don't have to pay as much in taxes as I could, and B, so that I can go to the bank and say, look, I qualify. I have enough cash to make this payment. So give me the loan.
Thank you. Let me see. I see a couple of more questions popping up here. Let me just take a look really quickly. Let me see. Does anybody have or know of any programs that can help with personal finances as well? Not just for businesses, but perhaps also for personal finances. And I know it's not related to the business question here, but I think it's an important question because sometimes some of the lenders do take a look at personal finances as part of qualifying your business to borrow money for access to capital. So it is important as well. So is there anything out there that it's available? Anybody?
One new platform that's emerged that is founded by a friend of mine is called Summa Wealth. You should check them out. They also have the same. They have it's all personal finance related information. It's a digital platform in English and in Spanish. So for the Spanish speakers in the room, they offer that as well. That's one platform that I know of. There's other online hubs, if you will, but I also encourage everybody to. There's a lot of local resources available for personal finance that you should plug and play. It can be at something as local where you need to do some bit more digging into your local community college and any workshops that they're offering for really cheap. So it's an investment of your time, but it shouldn't also take that much investment in terms of money. But if you're looking for a digital platform, Summa Wealth is one that I know.
Thank you, Sean. And with this, we're going to close the webinar. We've reached our limit. I want to thank all the panelists for participating. I want to thank all the attendees as well for showing up to this wonderful event. And keep your eyes open for new ones that are coming up from LAEDC. So thank you, everybody. Have a good day.